This is Dr. Sivaraman of iknowindustries.com. Today I'll be presenting the monthly webinar Tracking the Forex Market Together. Good day to one and all the latecomers. Good day. Let me display the PowerPoint presentation. Tracking the Forex Market Together Part 1 on May 28th between 5 and 5:45 GMT. So I will be giving it in two parts, one during that of the Japanese session, the other one during that of the US session. So I will give the trading decisions and the trading calls, and you will be able to see how exactly those trading calls mature during the course of the day. So for that we will be using the live market quote page. I have given the link for the same, and I'll focus the camera over that of the live market quote page, and you can see where exactly the current market is. Euro is currently trading around 1.2300, 1.2302. The low is 1.2282. The high is 1.2379. The net change is 60 pips negative. GBP is trading around 1.4535, 1.4539 and 36. Then the low is 1.4534. So GBP is trading closer to that of the low. Euro is also trading closer to that of the low. The high is slightly away, and yesterday's close level is higher. And from there, GBP has corrected about 48 pips. Euro has corrected about 61 pips. So you find that Euro has corrected more when compared to that of GBP. Then USD Yen is trading around 91 area, and it was all along coming from that of 89 area to 91 area. Now currently the low is 90.87 and the high is 91.34, and the net change is 2 pips positive. In the case of CHF, 1.1559, 1.1562 are the current levels. 1.1499 is the low, 1.1572 is the high. The net change is 51 pips positive. So when Euro has corrected about 60 pips, you come across CHF has gained about 51 pips. The commodity price, with regard to Euro and CHF, you find Euro has corrected a little more when compared to that of the rise in the case of USD CHF. As a result, Euro CHF has made a nominal negative net change of 5 pips. Then in the case of Euro, the net change is more when compared to that of GBP. As a result, you find Euro GBP has also shown a negative net change of 11 pips. Then this is what you come across. The Euro and GBP are showing USD gaining move, and USD Yen is showing a nominal USD gaining move. And also you come across USD gaining move in the case of CHF and also Canadian dollar. Whereas when CHF has gained about 51 pips, Canadian dollar has gained only about 36 pips. So you find that Canadian dollar has come down a little bit when compared to that of CHF. Then with regard to Australian dollar, which has gained significantly yesterday, and it is holding the high, and the low is 0.8464 and the high is 0.8532. The net change is 24 pips or 24 pips negative. So you find that when Euro and GBP has dropped more, Australian dollar has not dropped more. This is what the current level are. Then let me just to show you the slide with regard to the initial lows and the initial highs set for today, so that we'll be able to have a continuation of what has happened in this particular week. So here you come across that Euro is showing a low of 1.2282, which is intact, which is above that of the high, initial high of yesterday, 1.2274. Then further gain was seen yesterday, nearly about 200 plus pips of gain, and from there it has dropped. Still it is holding above that of yesterday's high. Then similarly in the case of GBP, which has also breached the level of Monday high 1.4485. Yesterday I was making a remark about that they have made less drop in the case of GBP when compared to that of Euro. So as a result, they are able to breach above that of the Monday high, initial high 1.4485, and the current low is 1.4536, whereas they have breached and formed a new low 1.4523. And in the case of euro, they are not breached the low. Then in the case of CHF, the initial highs and the initial lows are given here, and they are intact. Then in the case of Japanese yen, also the initial highs and the lows are intact, 90.87 and 91.34. Then with regard to Australian dollar, 84.64 is the low, which is intact, and 85.32 is the high. Sorry. It should be 85.32. 85.32 is the high, which is also intact. So you find range bound moves are seen, and Australian dollar is trading above that of the Monday initial high. So you find that euro and GBP are trading slightly above, and GBP has phenomenally gained the levels when compared to that of the Monday high. Then in the case of yen also, which is trading above that of the Monday high, around that particular area, 90.69 was the initial high and 90.67 is the current low. And in the case of Australian dollar, also it is trading above that of the Monday high, 83.62, and 84.64 is the current low. Then in the case of Canadian dollar, from Monday it has been gradually making a lower level, and current low is 1.0481 and 1.0518 are the current levels, and which is trading lower than the yesterday's low. So the downside is much more potential with regard to Canadian dollar. So let me minimize the slide and show the tracking the market slide. Now with regard to the session timings, and this is very important in order to make a tracking of the market, you have to understand the session timing. 0030 0730 GMT is the Japanese session, and 7:30 to 8 GMT is the gap time. 8 to 13 GMT is the European session, and 13 to 13:30 is the gap time. 13:30 to 20:30 is the US session, and 20:30 to 0030 is the gap time. So if you follow these timings, then my trading methodology, what I am going to give it, will be meaningful for you. Watch the forex market in all 6 pairs, 4 majors and 2 commodity pairs, 30 minutes from the start of the session. I have given the session timing. So if it is a Japanese session, you have to watch from 0030 to 1 GMT. If it is European session, from 7:30 to 8 GMT. If it is US session, from 13:30 to 14 GMT. You have to watch the market. Take sell position if a pair is near high and not cut the high during the 30 minutes of watching, or take a buy position if a pair is near low and not cut the low during the 30 minutes of watch. So this is what the basic information is. So currently you find it is 5 GMT. It is about 4.5 hours from that of our trading decision time, and you find currently euro and GBP are near that of the low, whereas in the case of GBP they breached the low. And also you come across in the case of only GBP they have cut the low. So we have to see how exactly we are going to take the trading decision. I'll explain it. In the event if they breached the low, then you have to wait for 2 hours. And when the new low has not been breached, then subsequently you have to take a buy position near that of the low. That is the only difference. If in the 30 minutes of observation, if they are not breached the low, then you can straight away take around 5-10 minutes after the 30 minutes closure, you can take a buy position. That will make a very good profit. And yesterday during that of the US session, I had given the call in the blog also. Then you would have seen how exactly they came closer to that of the low, almost to that of the low, but they are not breached it, and that is referred as a false move. So they make a false move before making their intentional move of making the gain. So that way, if you try to take it, you will be able to really fine tune your buys, and then once the position makes profit, you have to keep stop at entry in order to avoid any sort of loss incurring in that. In case if they hit your stop, does not matter, because you will find a better level to enter into the market. So you don't lose anything. In fact, you gain, you get an advantage out of that, and they make further drop. Then you wait for 2 hours. Then afterwards, you take a buy position. When that new low has not been breached for more than 30 minutes, you will be able to see definitely a profit making opportunity in the trade. So yesterday you would have noticed that they gained the levels all the way during that of the European session and then dropped during that of the close of the European session, and everybody thought that it is going to have a similar pattern and US dollar is going to gain, even though the data pertaining to US dollar was weak and the interpretation was risk aversion, but subsequently we found that risk appetite has come in. So this is how they alternatively create the market sentiments and trap the traders. So we need to really understand their mindset and understand the tactics and then trade accordingly rather than developing a bearish or a bullish mindset. Then once the position makes up, once you have taken the position, keep 30 pips stop. In case the hedging facility is not available, otherwise in a hedging order, which is also referred as an entry stop in the trading platform, to limit the risk. Once the position makes about 20-30 pips profit, keep stop at entry so that you are reducing the risk to nil. Then keep 30, 45 or 75 pips as the limit, and this limit you can take away from the market and use that stop as a trailing stop and try to maximize the profit. So this is the basic trading strategy. So in which we are not following any of the charts or any of the other type of technical analysis. We only look into that of the live market code page. Then besides, the forecast is given as a guidance and you can just use it in case if you feel that you can use the forecast. Otherwise, you can just ignore the forecast for the intraday trading also. And the forecast is that Euro and GBP are expected to make swing and come to the lower level and then form up again during this Japanese session. So let us take the trading decisions now and see how exactly our trades are going to mature in this session or before the early European session, so that we should be able to close the position, because I am trying to take the position towards the close of the Japanese session. So I can wait up to that of the European session and try to close the position, early European session, and try to close the position. In case if I had taken the position during the start of the session, I should be in a position to close it before the end of the Japanese session. And if you plan it that way, then you will find that the trading success really improves. If you try to do the intraday trade, then you have to obviously understand what is the time at which you can take a buy position when they are making an extreme low, and what is the best time you can take an exit in case you have already taken a buy position or entering a fresh sell position. So this is very important. For that, you need to identify the net change, whether they have done the permissible net change. If they have done the permissible net change, then once they stop cutting the high for more than 30 minutes, you can try to take a sell position near that of the high, or you can try to take a buy position if they are dropped fully and afterwards they stop cutting the low for more than 30 minutes in your observation time. Then you can take a buy position. That will work out even irrespective of the market condition, whether it has got a bearish appearance or a bullish appearance. Now, currently Euro is trading around 1.230406. The low is 1.2282. So, in order to give a benefit of doubt, and if they may not fill in the platform if I keep 1.2282 as a buy order, so I will just keep about 2 to 3 pips above that. So, I'll keep a buy limit order 1.2285 with an entry stop of 30 pips. So if I keep a buy limit order, if they fill it, fine. If they are not filling it in my observation of 30 minutes, and then I will try to buy it. That means already the traders have taken the sell position during the drop, and the players do not want to give the profit booking opportunity for them. That is why they are holding high and go up. So I wait for about 10 to 30 minutes after keeping the limit order, and if it is not filled in 30 minutes time, then I will try to take a buy position at the current market level 1.2307 or 1.2309, etc. Then still I'll keep 30 pips entry stop, so that I will take at any given time only 30 pips risk, or a stop, normal stop, in case if the hedging facility is not available. Then I will explain to you how to use the hedging afterwards once the decisions are being made. Now, in the case of GBP, 1.4523 is the low, 1.4531 or 32 is the current level, and the initial low I have already shown it. The initial low in the case of GBP is 1.4536. So obviously they are going to make a gain. They have gone above that of the initial high. So a brief downward move, what we observed about 5-10 minutes back, it was a stop punch. So we will keep a buy limit 1.4536 or 37 with an entry stop of 36. I am only keeping a limit order, and in order to find whether they are giving a fill to that. And they may appear that they are trying to firm up. But that is how they try to induce the traders to commit a position. Don't think that immediately they are going to rise Euro and GBP to heaven, and they will just gain about 10-15 pips and again drop it. That is how they make the swing here. Only when they make a circular trade of that nature, the traders will feel, okay, now GBP is rising, let me grab it. Then enter into it. Afterwards, they will find that they enter at a higher level, whereas they are showing at a lower level later on. So the best way is just keep a limit order near that of the low and see whether they are giving a fill to that. If they are not giving the fill in 10 to 30 minutes of observation, then understand that traders have taken, when they made a small dip, their traders have taken the sell position. That is why they do not want to give profit booking opportunity for them. Then obviously, because many traders after the gain of 200 pips would have thought that there will be a big correction today, so they would have taken a sell position because they have been doing similar exercise on a daily basis. So traders would have got the feel that this is what we have to do a trade, let them raise and tomorrow we will take a sell position. But they forget to understand that it is weakened and it is a trap time for that of the players. So they will trap it on the other side. After creating the market sentiment, weakened, they simply trap the traders. So in the case of USD CHF, 1.1553 is the current level, 1.1499 is the low. As I explained that they are expected to make the contrarian move, I will keep a buy limit order 1.1501 with an entry stop of 32. Just about 2-3 pips above that of the initial low, I am keeping buy order so that I should be able to get a definite fill on that. So that is considering the limitations of the trading platform. So in the trading platform, you might be noticed that if you keep a buy order at 1.1501 and a stop at 1.1499, then the platform will fill 1.1499, but they will not fill 1.1501. They ask how exactly you have filled my entry stop. They will say market came down up to 1.15. Then afterwards, because of the spread that got filled. But if you ask them why this buy was not filled, they will not have any answer for that. Because invariably they know very well, either the traders will keep a stop, entry stop or a stop, or a buy limit order. They will not keep simultaneously both orders to question the platform. So platform also, like the players, try to earn the money from that of the trade, their own clients, like urchins. Then USD Yen, current level is 91.07, the low is 90.87, the high is 91.34. We will keep a buy limit order 90.00. I will just keep it as 89.90, just 3 pips above that of the low and also just below that of the psychological level. So there could be a possibility that they can fill my order. If they are not filling it, then I'll try to grab it at the market level. Sorry, this 90.90 with an entry stop of 30 pips. In the case of Australian dollar, the next change is 9 pips negative now. It has gone above that of 0.85 and 0.8464 is the low. So I'll keep a buy limit order 0.8467 with an entry stop of 30 pips. See, this is how we test the market, whether the market has got a tendency to come down by keeping a limit order. It is not that we are expecting the market to come down to our level, fill and then go up. Okay, this is get the feel of the market without doing any sort of other type of analysis, trying to analyze what is the pivot point or try to analyze what is the stop, what is the resistance or the support, etc. For the simple reason that we know very well the market does not respect any of those points which are being statistically calculated, and they can breach it, and simply the statistician may say it is a noise, but if you go into that of the trade and the order will be filled. So that is reality. So if I keep it here, probably out of noise it might be filled, but I am very happy at the lowest level I taken a buy, then subsequently if the market rises I am able to keep stop at entry. So that is more important for us rather than calling it with a different name, because I want to practically do the trading and earn money from that of the market. That is my objective, not to become an expert in technical analysis or fundamental analysis, or not to be a advisor to the various governments with regard to their fundamentals. USD CAD, the low is 1.0481. So current level is 1.0505. So I'll keep a buy limit 1.0483 or 84 with an entry stop of 30 pips. So these are all the orders I have chosen. I am trying to take a decision of placing an order with a simple concept that I wanted to take a buy position near that of the low or a sell position near that of the high. If the market is near the high, I will try to keep the order slightly closer to that of the high. If they fill it, fine. Otherwise, I'll try to watch for about 10 to 30 minutes. If they are not filling it, I'll try to modify the order and take it at the market during a small firming up move and not during the drop. When they are dropping it, don't try to sell, because they do circular trade and drop and then gain the levels. And this is mainly to induce us to take a sell position and then subsequently they rise. So we have to assess what they are trying to do in relation to that of the highs and the lows set for the day and also the next change. And after gaining about 200 pips, they made a drop of about 50-60 pips to start with during the Japanese session. And so that is mainly to book profit of their buy position. Then subsequently they will buy again during a small drop and then gain the levels. So what happens? They are able to trap all the short sellers, and subsequently during the drop the short sellers might do the averaging. Then again the second position is also trapped. So without the knowledge, the short sellers try to get trapped by over trading. Similarly, during the drop, if you simply average it by 50 pips, 60 pips, then you will understand later on that you have taken more position that leads to over trading. So whether on the short side or on the long side, when you do over trading, obviously the usable margin will erode when the market moves against all the positions. Then you become panic, and that is the way they try to trigger your emotions, because they cannot put their hand through the computers and say, come on, you sell your long position. They cannot do that. But they can trigger your emotions and easily induce you to liquidate. And you know that yesterday they dropped euro to 1.2721 area, and subsequently they gained the levels. And again during the US session they dropped it for you to become bearish and subsequently gain. So this is how they always try to do a trap move. If you think that because of the US, the Greek crisis, euro is dropping, which is not getting any strength and things like that, and you are not going to be successful in your trade. You can do either buy and sell trade or a sell and buy trade, but you have to decide you have to identify where the market is, accordingly take the trading decision. Because we are not interested in grabbing about 1000 pips or 5000 pips and things like that. We are interested in only making about 40-50 pips in our trade. We are happy with that. So obviously we have to identify where exactly you can where exactly you can come across such type of trade. And for that, the start of the session and the end of the session, they handle the majors. And during the mid session, they handle the crosses. In case if you want to take the positions in the case of crosses, you have to wait for the mid sessions, and then when the market is near that of the low, you can take a buy position, and when the market is near that of the high, you can take a sell position. Then in the case of crosses, try to keep 50 pips hedging order instead of 30 pips, because the volatility is more in the case of the crosses when compared to that of the majors. Now with regard to the GBP yen, for example, current level is 132.47. 132.27 is the low. So I will keep a buy limit order. $132.29 with an entry stop of 50 pips. Why I am doing a buy and sell trade here? Because I explained that euro is expected to gain and also yen is expected to gain. Yesterday they gained about 200 to 300 pips in the case of crosses, and you might be thinking that they will be retracing some, or they may drop at least 50% and then gain. That is not the way they do it. They trapped all the short sellers at those levels. Then sub follow up, they make the gain and induce them to do the short covering, because they are in the process of making money. They are not here to obey the technical analysis. So we have to understand. It may appear the market obeys technical analysis, and we are only trying to identify the herd mentality of the traders using technical analysis, but we are not able to identify what the players intend to do. 2/3 of the market volume is of the players and 1/3 of the market volume is of the traders. So obviously with 1/3 volume, if you try to do analysis, obviously it will not be able to reflect with regard to the whole market condition, because the market is being manipulated and the players have got a better control over the other market. Then in the case of euro yen, 112.21 is the low and the current low is 101.92. So I'll try to keep a buy limit order. $111.95 with an entry stop of 50. Then in the case of euro GBP, as I explained that they had dropped initially euro less and GBP more, and subsequently you find that now the net change in the case of euro is 49 pips and net change in the case of GBP is 44 pips. So gradually they are gaining the levels in the case of GBP when compared to that of euro. So as a result you find net change in the case of euro GBP is 7 pips negative. The high is 0.898491. So I will try to keep a sell limit order, because current level is 0.8468 and it has come to that of the middle level. So I will try to keep a sell limit order at 0.8489. Just 2 pips lower than that of the high with an entry stop of 50 pips. So It is not that I am trying to read it from 0.87 or 0.88 how exactly it has dropped. When I try to do that analysis, I will find invariably it could make a turnaround around that 0.84. But just watch it for the intraday. I find the high is only 84.91. The net change is negative and they dropped again. They could retest the high and then go down because the net change in the case of euro is more when compared to that of GBP. So their intention is to drop euro GBP. So that is how I take a trading decision on this. But still, I will not say that my trading decision is 100% perfect. It can go wrong because the players would have seen that a lot of traders taking sell positions there, then they may make another 100 pips gain and hit all the stops and then drop down. So I am keeping an entry stop of 50 pips to limit the risk. I only take a chance for 50 pips, and if they go above, then hedging will be filled. Okay, when the hedging is filled, how exactly I am going to handle it is very important. So let me save all these things. Now, in the case of euro, let me explain to you. So because many of the people are familiar with the euro level, so 1.2285 I am keeping a buy limit order. Suppose it is filled and subsequently the market dropped 30 pips. So I will be having a hedging at 1.225. Okay, I got the hedging order filled. So now market is trading in between. So there comes the confusion for many of the traders. After filling the hedge, the market is staying in between. So how do I handle my hedge? So this is what people invariably think about. So in this, there are various options available. The first option, when the market has filled my hedging and the hedging is making loss for 10 to 30 minutes. That means they have filled the hedging during a downward stop and subsequently they are not dropping it. Anybody who has taken a sell position at this level is not making profit for 30 minutes and obviously they wanted to gain the level. So I try to close this hedging with a nominal loss of 5 to 10 pips and keep another hedging order 30 pips below. So another entry stop 30 pips below I keep it, and once they gain the levels in the market, if they drop it, I am only taking a risk for 30 pips. And the initially I have taken risk for 30 pips, another risk for 30 pips. So it is a measured risk. I am not taking unlimited risk. And I will change my trading strategy if they hit my second hedging order as well. So that means they are dropping it. I am against the trade. So I will not close my hedging. I will just watch. And if the hedging makes profit, I'll try to keep stop at entry in the hedging. Let them drop it even to 1.20. I'm not worried because my position is hedged. My loss is locked at 60 pips. At any given time, I can simply close my buy position with the hedge position. So my loss is determined. So I have blocked the money already for that. And if the market goes to 1.20, fine. Or 1.19, fine. I'm not worried. Once they come up, because market cannot continuously drop or continuously rise, just to make volatile moves. So once they come up, and if they close my hedging, stop at entry, then I continue to trade with my buy position. So it is simple. It is a question of patience. So that is very, very important for us. And the trading strategies are all, they are the only one which can help you in becoming a successful trader rather than any sort of analysis, any sort of forecast, etc. Because every forecast has got their own limitation. You have to understand that. Then, in case if they hedged me and gone up, I am seeing about 10-15 pips loss, I'll accept the loss. So whenever a loss is small, try to accept it. And if it is making loss even still for 2 hours, then try to close it. In case if I fail to close it, and market has gone above 1.2285, it has gone to 1.2350. What do I do? See, my loss is limited to 30 pips. So when this particular sell position is making 60 pips loss, my buy position might be making 30 pips profit. So even if I close my hedging with 60 pips loss and I am not losing 60 pips, I have already got 30 pips in my buy position, and so I can close it even with 60 pips and keep another hedging or keep stop at entry in my buy position and continue that as a trailing stop, and as they gain another 30 pips, I have a break even. And once they go up, then I am able to earn money from that of the market. In case if they are dropping it, then 1.2285 is making about 60 pips loss and this is making 30 pips profit. Okay, I'll close my sell buy position and keep stop at entry in my sell position. And if they continue to drop another 30 pips, I am having a break even. If they drop another 200 pips, I am very happy about it. I am able to earn out of my sell position. So I don't become panic when they drop euro or when they rise euro. So that is possible if you use the hedging effectively, and you should have the mindset and the patience. And see, now euro and GBP have gone up, I have not become perturbed. I know that they will make a small swing, still they have not cut the high and stayed above that of the high for more than 30 minutes for me to do a breakout trade. Many traders thinking that this is a statistical level, say for example 1.2379. So after 1.2379, if it breaks, then straight away jump into the market. You will be able to see it will go to 1.24. That is what they think. But they can go up to 1.2399 and then drop all the way down to 1.23. Then your breakout trade makes a huge loss. So even if you think of a breakout trade, try to keep the hedging order below that of the initial high, 1.2379. In case if you are taking a buy position at 2385, then try to keep 30 pips below a hedging order to limit the risk. In case if they drop it, you just see whether the hedging is making profit. Simply close your buy position and take another sell position. And in both the sell position, you should be able to close it near the low and you will be able to earn substantially. So this is how you should be able to tactfully handle your positions in the market rather than simply worrying about what is going to happen to the European economy, why Greece is creating so much of crisis, why the world is undergoing so much of crisis. Is it because of the sin? If you think like that, you will never be in a position to trade effectively. So let me explain to you the advantages of hedging. So hedging is used instead of stop, I explained to you. Then hedging is used to continue trading when the market moves in our favor. So when the hedging is not filled and we are able to keep stop at entry, then we continue to trade with our original position. If the market goes again, simply we use the hedging to limit the risk. Hedging can be used to do either way trade. I explained how exactly when they drop, you can cut the buy position and maximize the profit with the sell position. If they gain the levels, then cut the sell position and maximize the profit with the buy position. And here, once it is hedged, you have to watch it calmly and see how exactly the hedging is making profit or loss. That sort of analysis is very important. And in that, the helping hand can be obtained from that of the net change. If the net change is, say, positive, even after the drop, yesterday after the drop from, in the case of Euro and GBP during the early European session, the net change was positive. Even though they dropped about 100 pips, still net change was positive. So then once they come to the psychological level 1.2204, they have stopped going it. And you would have noticed in the trading platform, they showed the bid 1.2204 and the ask 1.2204 without any spread. That means they use a all or none sell order to hit all the stops and keep a huge buy order 1.2204, 1.2210 and things like that, accumulated all the stops, then gone up. So when they are doing it and visibility is available in the live market quote page, and why you just ignore it and think of something else about the economic conditions of various countries. Then hedging can be used to reverse the trade when the other way going is good. That was I explained to you. When they make opposite move, you will be able to handle still your pending positions. Then hedging is used to hold the position and continue trading when time permits. In the event of emergency, we can hedge and leave the trade. That is our advantage. Suppose if there is an emergency call and you need to leave the trading platform, you simply hedge it and go away. And after about 2 days you are coming, doesn't matter. After about 1 week you are coming, fine. Then still, if the hedging is making about say 150 pips loss and your original position is making 120 pips profit, you can simply close the hedging and continue to maximize the profit with the original position. Or on the other side, the original position is making loss of 150 pips, the hedging is making 120 pips profit. You can just watch whether the market, whenever you want to close the sell hedge, you try to close it near that of the market. Whenever you want to close the buy position, try to close it near that of the low of the day. Then you will find that the hedging is not being filled very frequently. It is something like yet another trade. That's all. Then hedging is used to hold the position, continue trading when time permits. I explained it. And in case if you are not very happy after coming down and you find that the hedging and the original positions are quite far away, you do not want to book a loss of 150 pips and things like that, you simply close your hedging with that of the original position, still accept 30 pips loss. Then hedging can be used to close the position at any time frame instead of stopping out the position during uncertainties. And invariably, if you use a stop, yesterday you would have used the stop during the downward move, and the stop would have filled your, closed your buy position, and subsequently they gained the level, and you would not have participated in that. Instead, they would have dropped it fine. You will be happy that you have limited the risk. And why people hesitate using the stop? Because we know very well it is an unwritten statement that players are stop hunters. So obviously, when they try to see the stop, they hit the stop and go away, then you will lose your position. If it is hedged, your positions are held in the trading platform. You can close whichever position you wanted to close, either the sell position or the buy position. That option is available for you. But once the position is closed, you become panic and you find that your usable margin is eroded and you hesitate taking another trade. So that gives you a mental block for you. Hedging can be used to spread the risk with a limited risk at each position. Suppose somebody is trying to do a position trade every 150 pips. They wanted to take a buy position. Simply taking every 150 pips drop, taking a buy position. And whenever the last position is making profit or the second position is making profit, close it. Book it with profit. And if they drop it, again re-enter in the market buy position. When they further drop it, again buy it and try to close it when they gain the levels. So that sort of trade many people do it. And there again, if you use the hedging, then if they continue to drop, you need not even watch the trading platform all the time. If you are using the orders of hedging here, then when they make an extreme move in that particular month, you'll find all the hedgings will be making profit. If they have made a downward move, book profit in all the hedgings and keep a cumulative hedging order at the bottom. Then when they gain all the levels, you'll find you will be able to close all the buy position above their average. 50% retracement is a common factor in the market. So you'll be able to close all the buy position as well. Then either way the market move, okay, you are in profit. Then hedging can be used to spread the risk, I explained. Then hedging can be used for breakout trade, as I explained it. Above 1.2379, you feel that if they are going to take it up, then take a buy position and keep the hedging order below that so that you don't take unlimited risk on the breakout trade. And many of the traders, they wait for the market to swing and try to go in for a breakout trade, thinking that that is full. But the players also know how the traders are entering into the market. So accordingly, they are going to change their strategy and hit the stop. So whatever the trading decision you try to take it, and they are going to be at you. So there is no other way you can escape because those orders are visible to them and their orders are not visible to us. Obviously, we have to be very careful on that and use the hedging. That is the main reason that hedging has been abolished. Hedging can be used without additional margin in many of the trading platforms. And why hedging is being hedging is not taking any additional margin in many of the platforms. Suppose you are using about 1 is to 200 leverage as a typical example, then $500 you give to that platform in order to take one standard lot. And if you try to use the hedging, they don't take another $500. Whereas if you try to use it in another cross, or or try to use it with the two different accounts, and both accounts will be attracting the margin. Whereas if the trading platform provides the hedging, then obviously we are not going to take the additional margin for the hedging. This is a typical example because some platforms they charge additional margin, and that is not fair. And they are supposed to use the same margin because you have taken the positions. Any one of the positions will be in the money. So obviously they are not supposed to take the margin for it. So this is the list of the advantages of hedging. And if you think that hedging reflects that you do not know how to do trading, that is what the NFA was making a recommendation in 2001 and 2000, and they abolished hedging, and silently they introduced hedging again in 2002, 2003, and again they have withdrawn it. So you can understand the same act has been introduced and withdrawn and introduced. What sort of idea they have, you can understand. So let me just go through the questions which are asked here, because I have taken more time in explaining the market and the trading strategy, because that is more important. I thought, let me take up the questions. I don't know how many questions I'll be able to take it up, but not many. Fine. Then in pro chart, if they are still cutting the new high or low, can we buy, sell on the direction of the new level, or wait? You have to wait necessarily for 30 minutes and see whether it is a stop point or they are making an intentional move of dropping it or rising it. So once you wait for 30 minutes, you will be able to get the clarity. You need not even cross check with me. And if you develop the habit of watching the live market quote page, and you will be able to really get that insight. Besides, I also explained during the Asian session live market analysis, they show a higher bid and a higher ask and things like that. They are the signal. They give it to their counterparts, and with which we will be able to recognize whether they wanted to make a rise or wanted to make a drop. So it is very easy for us to read them based on their market moves, because they are cunning all the time. So when you are handling when you are handling a situation in front of a cunning man and he becomes your partner, and you know how cautious you will be. No, you know very well that partner is cunning and he is trying to deceive you at any given time. Will you give a chance? No, you will not give a chance. And obviously you will be alert and try to see or read in between what he is trying to do out of that, whether he is misguiding or whether he is trying to help you. So that sort of analysis you need to do it with regard to the market rather than doing anything else. And if they drop, say, if they cut the low in 30 minutes and followed by that in next 30 minutes, if they cut the low, you have to wait for 2 hours. Because that means they wanted to drop 3 times before making further rise. And always try to understand that during start of the session, end of the session, they will try to make extreme moves. You would have noticed yesterday, during the early European session, they made the quick gain, and towards close of the European session, around 13 GMT, they came to the below 1.22 area. Then subsequently, during start of the European US session, they came again to 1.2204, then went up. So this is how they do it. During the gap time, they gain the levels and again drop it. You know, gap time moves are false move. They gain the levels. That means they are going to drop in first 30 minutes around 14:10 GMT. You wait up to 14 GMT. Around 14:05 or 14:10 GMT. If you try to take a buy position, you will find it is really making profit. So you don't require any more analysis pertaining to that. And you try it in a demo trading platform. And if it works consistently in different market conditions, then try to use your own ideas, how exactly you can improvise the trade. And this is only a basic trading strategy I explained. The other trading strategies are being taught only those who are paying for the professional trading training. So obviously I cannot give all those calls here or the ideas here. Still, it is not difficult for you to read it or for you to understand and for you to have a in-depth analysis of this trading strategy and try to improvise it. Then able. Can you explain again that euro entry 1.2285, something about 10 minutes and 30 minutes. Also, we are chosen to end the Japanese session, but your method is 30 minutes from open. Yes, the method is from 30 minutes open, but the webinar time is scheduled between 5 and 5:45 GMT, so I cannot have it by 1 GMT. So anyhow, your session is by 14 GMT, 30 minutes from start of the session. So according to the webinar available time, I should be able to explain to you. So that is the rule, but I just place the limit orders to show how exactly near the low we can buy, how exactly near the high we can take a sell. And this 10 to 30 minutes rule is in case if it is hedged, or in case if the limit order is not filled. Always you watch for 30 minutes because intraday trend reversals happen every 30 minutes. Even if it is a 5-10 pip swing, you find that they just make every 30 minutes. And if you use a 30 minutes chart, and then entire charm is lost. Because that get absorbed and it becomes one single candle. You will not be able to perceive it. If you watch 30 minutes, the price action, you will be able to really understand how 15 pips they are making up and down moves. In the case of GBP, they went up to 1.4560 and again they dropped it to 1.4545. That is how they induce the traders to take a buy position and then finally make one downward move up to that of the low or try to hit the stops below that of the low and then go up. So if I keep a limit order during that time, it will get killed. Rather than trying to emotionally enter into the market once you develop a bullish feel or emotionally enter into the market once you develop a bearish feel. All the buy limits on the initial lows of the day. Yes, buy limits are near that of the initial low of the day because it is Japanese session. Then during that of the US session, I will explain to you. And in case if euro has gone up to 1.24 or 1.22, there are two possibilities. Okay, when it comes to 1.22, I will find that okay, 1.2282 is the low. They have come below that and see for 30 minutes to 2 hours whether they are going further down. If they are not going further down in 2 hours time, then I will try to take a buy there. And in case if they have gone up, then it has gone to 1.2450 and subsequently dropped. I'll see how exactly the psychological levels they are trying to handle it, whether at 1.2425 or 1.24 or 1.2375 and the initial high. How exactly they handle all those things. And if they are breaching easily, then I'll wait. And if they are not breaching the intermediary level, and if you watch the price action only, you will be able to identify up to what intermediary level. Yesterday, the low was 1.2155 in the case of euro, and they have been hovering around 1.22 area. So, you will not be able to judge. You will be always trying to draw a channel line from 1.2155. So, obviously, 1.22, you don't find it as a good entry level, but up to the psychological level 1.22, they have come down and then gone up. So, that sort of understanding can be achieved if you look into that of the price action rather than the chart. I don't recommend anybody to look into the chart because invariably that does not help us making money. It might be useful to do a postmortem of the market. Okay, new aid. Why buy limit for all pairs? Are you expecting contrarian move? Yeah, I explained that I am expecting the contrarian move and continuation of the contrarian move. After the initial USD gaining move, they are expected to make the contrarian move. And that is why, because alternatively they gain the levels. If you see the past, you will be able to understand there has been consistently gaining level. In the case of yen, they gain the level. In the case of CHF, they gain the levels. In the case of Australian dollar, they gain the level. Canadian dollar, they gain the levels. And also euro and GBP, they gain the levels. What more evidence you require that they are gaining the levels in all currency pairs? Then Arun, your post yesterday in the blog is there will be a same drop and rise move will happen. I mean that euro can come to 1.4450, 2250. Okay, as far as the levels are concerned, it depends upon the shorts built up during the start of the day and yesterday also. Some people would have gone short during the initial rise in the case of euro, and they would have been trapped and they would not have done the short covering. If they are not done the short covering, they are not going to drop, the players are not going to drop euro and GBP. They have done already the short covering after the gain of 200 pips and turn long, then they will be trying to drop the market. So you have to understand the levels are determined depending upon the emotional factors of the traders, nothing to do with statistics. And so here it is no guarantee that it can come to 1.2250 or 1.450. You have to see the price action, how exactly they are doing during the close of the session, start of the session, that is very important, gap time. So whatever the levels they show, some fool has taken a lowest level sell or some fool has taken a highest level buy out of emotions. That is how the highs and the lows are being set. The players take it around that of the psychological level and they do the circular trade and drop and cut the low once. Then subsequently they just keep a all or none order below that of the low and keep a buy order. So all the stops will get exposed and the normal buy order will take the position. So that is how at the lowest level they take a buy. Similarly, the highest level, they try to use the all or none order and try to gain the levels and keep their normal sell order, and that sell order will fill all the stops. So this is how they become stop hunters. So they have got a technique, computer technique, with which they are able to handle it that way. So obviously you should not develop a mental block, okay, they can come up to 1.250 or they can come up to 1.22. Don't develop a mental block and try to follow the timing. So during the start of the session and the end of the session, how exactly they are doing it, you watch it. And they will either they will come closer to the high or closer to the low. So when they are coming closer to the low and see how exactly that low they are not breaching for 30 minutes and try to take a buy. So that will be the low set for the day, and that does not give any greatness for us. Okay, I determined that it can come up to 1.2250. It came up to 1.2251. My call is great. What is the use? Whether I am benefited out of that is more important. Then all play positions, that is what I explained. I am expecting that alternative moves here in the market as a contrary move. That is why all buy orders. Able, they want to drop euro GBP, they would not. You expect to drop euro and USD also. See, euro GBP can be dropped by various methods. See, they can drop euro, price GBP. Thereby, euro GBP can drop. They can rise euro GBP 100 pips and hold euro, still euro GBP can drop. So they have various methods. Similarly, they can hold GBP and drop very severely euro also. That way, euro GBP can drop. So it is not that by dropping euro only, euro GBP has to drop. Yesterday, for example, they gained 200 plus pips in the case of euro, gained in the case of GBP 200 plus pips, and they have been holding around 0.8494 all along. So no impact on euro GBP because they are focusing on the majors rather than the crosses at that time. So when they are focusing on the majors, try to do trades in majors. When they are focusing on the crosses, try to do trades in cross. So whenever they make contrarian move, that's what I have been explaining, that they are focusing on the crosses. Don't waste your time taking position in majors at that time when they are handling crosses. So this is how you should be able to take your trading decision with regard to the timings of the market. Which platform provide hedging? Probably I request you to search or look into that of the brokers list which is given in FX Street or any of the websites. There you can find the facilities provided by that of the broker, hedging facility or not. So most of the UK platform providers, Australian platform providers and other country platform providers, they are offering hedging, excepting US platforms. And there are some platforms, they don't disclose hedging freely, and if you ask for hedging, they incorporate the hedging facility in that. So you have to find out from them before opening an account. I do not want to recommend any platform here because I know that the platform providers grab the client's money. And yes, please put the slide up. What expected in the European and US session? I'll give it in the blog, please. I don't have much time here. I already breached. Do you normally close the position you entered within the same session? Yes. I try to close it within the same session if it is a swing trade. When the going is good, I try to keep the stop 30 pips to protect a minimum profit, then maximize the profit. So ultimately the trading strategy is going to help you in maximizing the profit. How many pips gain do you wait before putting the entry stop in the trade? I explained that when the entry, as soon as the position is taken, I keep the entry stop. There is no question of the position becomes unfavorable afterwards I am keeping an entry stop. That is wrong. So I determined I can take only 30 pips loss. So I keep entry stop as soon as I have kept my position. So it is something like you are going to a shop, you have got about $50 in your purse. And will you do shopping for $70? No, not at all. You'll try to do the shopping for about $30, $40 only. So in the same way, you have to decide, okay, up to what I can take risk. You have to decide before entering into that market. This is common sense, but we don't apply it when you are doing trading. And once it becomes ours, you try to think of hedging. That is crisis management. Then once you enter into crisis management, you have to withstand the pressure of crisis. Then how do you do whether the buy or sell based on your focus? Not necessarily based on the focus. I explained that when the market is near the high, not cut the high, you can take a sell position around start 1 GMT. The market was near the high, not cut the high, you would have taken a sell position and book the profit now. Now, towards the close of the Japanese session, I am trying to take a buy position, try to close it during that of the close of the Japanese session or gap time or during early European session. I hope FX Trade will let you have your webinar at the start of the London session. I have been doing the webinar during the start of the London session, but many of the people found it inconvenient, not able to log in and things like that, because most of the US clients, they found it that is too early, too late for them to attend your webinar. That is why we are experimenting with regard to the Japanese and the US session. Okay, so we are trying various methods to find out how exactly we can help the traders to gain money from the other market. So let me not waste much time and let me go to that of the PowerPoint presentation. So I will come back again by 14 GMT and take up the calls for the US session, and also I will review what happened to that of the limit orders I placed, whether I just modified and taken the buy position in the market, and also I'll explain to you in case they are hedged, how exactly I handle the hedge. And also I'll give the calls for that of the US session and see how exactly within the US session the call gets matured. And we will try to do this sort of analysis once a month as tracking the forex market together. And almost every day I'm doing it in the 18th session and follow it up through the blog. But here it is done in the form of a webinar. Okay. So thanks for attending my webinar, and again we'll meet by 14 GMT. Until then, bye.